High inflation, weak global growth, and interest rate hikes are also weighing on UK consumers and weakening the economy. UK Chancellor of the Exchequer Jeremy Hunt spoke alongside Bank of England Governor Andrew Bailey on Monday and expressed a willingness to take action to bring inflation back to its 2% target. And they are quite far away from that yet. Speaking to financial sector executives at the annual Mansion House dinner in the City of London, the politician stressed that he will get the job done to bring inflation down. Working with the Governor and the Bank of England, we will last for so long, do what it takes as necessary to tackle persistent inflation and bring it back to the 2% target, he said. Britain Hunt also suggested companies hold back on profit margins, reiterating his earlier view. Fighting inflation must come before tax cuts. The government has suggested that the pension industry could potentially negotiate with private equity firms to charge just 1% for the annual management fee and 10% for the performance fee. Laura Trott, the pension secretary, said returns could vary and the government made reasonable assumptions in the report. And she added that returns could be higher if a 5% private equity allocation replaced bonds instead of equities. However, Rebecca O'Connor of the provider PensionBee said she couldn't imagine pension funds being able to negotiate such low amounts. And she said, it's going to be very difficult because there's a reason private equity firms charge such high fees. Startup growth companies require a lot of research, and you're not going to be able to lower the fees because the workload involved is increasing and will be high. Therefore, such systems are usually not accessible to normal savers. And she added, we have to ask ourselves who these reforms are really for, when the models suggest that the gains for savers could actually be quite small. And this came as Jeremy Hunt appeared to overrule the city's regulator by proposing a relaxation of short-selling rules. On Tuesday, after a consultation, the Treasury proposed relaxing reporting and disclosure rules for short sellers. And last month, The Telegraph revealed that the Financial Conduct Authority, the FCA, was opposed to any significant relaxation of European-era rules. Officials said they wanted to retain key elements of the current regulations when meeting with party industry stakeholders. In short selling, traders borrow stocks that they think will fall in price, sell them, and then wait for the price to fall before buying them back. The dealer then pocketed the difference, and this is a strategy often used by hedge funds. The Treasury said it would raise the threshold above which traders are required to report short positions to the FCA from 0.1% to 0.2% of total issued share capital. It was understood that the FCA wanted to leave the threshold at 0.1% on the grounds that it would allow them to have a fuller picture of what was happening in financial markets and become more data-driven, as they put it. The Treasury said the change strike a better balance between providing sufficient data for the FCA to carry out its duties and appropriate burdens on reporting entities. Well, additional to that, the Bank of England surprisingly recently raised the key interest rate by 0.5 percentage points, thereby speeding up the fight against inflation. Although the BOE had already heralded the U-turn in interest rates in December 21 and thus significantly earlier than the European Central Bank and the US Federal Reserve, as the annual inflation rate stagnated in May at 8.7%. Core inflation, which excludes energy and food sectors, even rose from 6.8 to 7.1%, and that's the highest level in 31 years. Great Britain is facing several serious challenges, and the reason for the stubborn inflation is, in addition to the initially hesitant reaction to stronger price increases, above all, a lack of supply on the labor market. The labor shortage, which has been significantly exacerbated by the lack of foreign workers since Brexit, is causing wages to rise sharply and labor productivity to fall. The sharp rise in consumer prices is also causing disposable income to shrink. Per capita household income has recently fallen significantly, which poses major challenges for socially disadvantaged households and for them in particular. Some sectors continued to report solid consumer spending, which can be attributed to the still high savings from the corona period and the high level of employment. But there are changes too. But rising interest payments are increasingly burdening private budgets. The BOE's monetary policy stance is also raising concerns of a widespread crisis in the housing market, as many homeowners have variable rate loans and are directly affected by rising financing conditions. According to surveys, half of mortgage holders are already having problems with their loan obligations. Falling house prices further exacerbated the situation. At the same time, national debt has risen to around 100% of economic output for the first time since 1961. In addition to curbing inflation, this jeopardizes another declared goal of the government under Prime Minister Rishi Sunak, the consolidation of public finances. Along with a slowdown in investment and foreign trade, the likelihood of the UK economy slipping into recession in the coming months is still increasing, even if that didn't happen so far. The question currently dominating the capital markets is how far the BOE will raise interest rates. The central bank's unexpectedly strong reaction to the latest inflation data initially caused the pound sterling to collapse, while the yield on British government bonds with a remaining term of 10 years rose to 4.7% a year. That's the highest level since 2008. And the British share index FTSE 100 lost around 2% immediately after the interest rate decision. In addition to the dynamics of the global economy, the further course of the BOE will also be relevant for further development. Therefore, the publication of the minutes of the last BOE meeting, as well as the current weaker expected data on economic growth and industrial production, each for May, are under special observation. Even in the event of positive surprises, the pound and British equities are likely to trend weaker for the time being. And as I mentioned, Brexit is exacerbating the inflation. And I know that many Brexiteers will deny that, blah, blah, blah. But look at the other countries of the same size and strength in Europe, in continental Europe. How is their inflation doing? I mean, I repeated that several times now. My prices here are going down. When I go food shopping, I pay less than a few months ago. And that is a sign I don't hear from any of my friends in the UK. And they are from different parts of the country, and it doesn't look like it looks here. And I talked about George Useless in a video recently, and his plans to give out more visas. There was a very intelligent comment under that video, because I forgot to mention that while I was talking about useless plans. Indeed, they already made a visa scheme because of the labor shortage, but how many people from the EU applied for those visas? It wasn't many. I don't know, I haven't checked now, but it's not the 50 anymore that we had a few months ago, but it's not much more. I could read that, but I didn't look for the exact number now. That's not because it's not important. If it's 70 or 75, nobody cares. They wanted thousands, and they just got a few handfuls. And that shows how useful the idea of useless would be. But that is something, as long as this government doesn't understand that Brexit was a mistake, and a lot of people that are going to vote in late 24, early 25 still don't want to admit that, we will not see anything very reasonable in politics. But that will keep me going talking about Brexit instead of other UK politics here on this channel, because Brexit keeps us busy, and it will keep us busy in the long distance. But sometimes I get a rest from politics, and that's why you always see this banner up there. I already started the new Outside Views STFC channel. Some of you already contributed to the work. It needs investment if I want to show certain things to the people on that channel. And so I'm very grateful to everyone that already contributed to the new channel and the work of the new channel. And it's doing quite well for a 4-week-old channel that has no link to the topic of this one. Over 100 subscribers and thousands of views is a very good start for a brand new channel with a brand new topic. So I'm even more grateful for the support you gave. But I still could need some more support for the new channel. So if you ever thought about supporting the work of Outside Views, think about it. And if you haven't visited me on Outside Views STFC, just give it a try. Perhaps you are interested, although you thought you are not. Just have a look. And I'll see you in my next video. I'll be back.